Hello, everybody. Today is October 13th, 2025, and welcome back to the Monday Market Update. Now, I can't begin without the biggest news on my radar. One of the wild cards I mentioned last week was the Middle East. And you may know by now that I've been in Israel with my family for the Jewish holidays. And as I was here in 2023 when this war began and 250 hostages were taken, I'm not making political statements. I really am not. Only that as of this morning in Israel, for the first time since 2014, there are no known living Israeli hostages held by Hamas. It's an amazing day here as the country welcomes home the 20 remaining living hostages from over 738 days in captivity. What happens next remains to be seen, but this is a good day. Back to the markets. Let's recap last week's action and let's preview this week. Last week was one of those weeks that reminded us how fast momentum can shift. We started the week hitting new record highs, powered once again by AI headlines and investor enthusiasm. And then Friday came along with a harsh reminder that optimism alone doesn't make us immune to risk. So let's walk through the week because each day told a slightly different story about where this market's confidence really sits. Monday kicked off with fireworks. What lit the match? A blockbuster partnership between AMD and OpenAI that sent AMD shares up nearly 25% and reignited that AI trade. Tech led the way. Semiconductors ripped higher. Enthusiasm spilled across the major indices, lifting the S&P and Nasdaq to fresh all-time closing highs. Now, this all came despite a few flashing headlines, a lingering government shutdown, talk of new tariffs from the White House, and more questions about whether valuations have just gone too far. But for the moment, the market didn't care. AI was the story, and anything that hinted at growth, innovation, or computing power kept buyers coming back for more. Under the surface, though, analysts were already warning this rally's running almost entirely on sentiment tied to one industry. When that happens, it doesn't take much to shake that confidence. The Dow was flat on the day, the S&P 500 up a quarter of 1% on the day, and the Nasdaq up three quarters of 1%. Tuesday, that shake in confidence, it did start to show. With the government still shut down, the economic calendar was basically blank. No CPI, no jobs data, no retail sales, nothing. And when traders don't have data, they trade on mood. The mood turned cautious. A few late day tariff tweets out of Washington took some of the shine off big tech, and by the close, we saw the first meaningful pullback in more than a week. Defensives like utilities and consumer staples, hey, they held up. Energy lagged as oil drifted lower. But the more interesting story wasn't price, it was positioning. After weeks of relentless buying, investors started to quietly take profits and rotate towards safety. Still, the underlying narrative was intact. AI enthusiasm remained the market's number one influence, and traders viewed any dip as temporary. The Dow was down a quarter of 1%, S&P down a half of 1%, and the Nasdaq was down three quarters of 1%. Wednesday gave us our first real crack in the armor. The culprit, the first negative AI headline we've had in a while, reports that Oracle lost $100 million renting NVIDIA's Blackwell chips. Doesn't sound huge in dollar terms, but psychologically it mattered. It raised the question, are companies paying too much for AI growth that hasn't fully materialized yet? At the same time, the World Trade Organization slashed its global trade outlook for 2026 because of tariffs. That sent investors rushing to hedges. Gold jumped above $4,000 an ounce for the first time ever. Midday, a few Fed speakers tried to calm nerves. Atlanta's Bostic and Governor Miron both talked about uncertainty in the data and patience on policy. But a small uptick in inflation expectations out of the New York Fed was enough to keep risk assets on edge. By the afternoon, S&P defended the 6,700 level, but it was clear that traders were beginning to test just how durable this AI narrative really is. The Dow was down a quarter of 1%, S&P down a half of 1%, and the Nasdaq was down three quarters of 1%. Thursday was a reminder of just how sensitive markets are to central bank tone. Overnight, the Bank of New Zealand, remember we've talked about that every now and then, like out there. But the Bank of New Zealand surprised markets with a 50 basis point rate cut. That's twice what was expected, and that sent a wave of global relief through equity markets. Just to be clear, twice expectations were just 50 basis points, not 25. That's half of 1%, not a quarter of 1%. This not only reminds us how sensitive we are to expectations, but reminds us to the levels and the sensitivity to even small changes like that. Stocks opened strong, powered by yet another round of upbeat AI news, this time from NVIDIA's Jensen Huang, who reaffirmed heavy demand for the company's Blackwell chips and even teased investments into Elon Musk's XAI venture. For a while, it looked like another melt up day, but by the afternoon, enthusiasm met reality. The FOMC minutes came out largely benign with no new hawkish surprises, and yet that's what worried some traders. In client calls in the past few weeks, as I've read again this week in one of my research sources, the AI enthusiasm does need a reality check every now and then. You know how sometimes you want to give a letter or an email to someone who has no idea what it is about so that they can give you a fresh look at it? This is needed in the markets today. And much like our everyone is on one side of the boat market, it's hard to find this. So here's one. When companies start financing their own customers to buy their products, as we're now seeing in parts of the chip and cloud ecosystem, this is when a company like Nvidia, for example, invests $100 billion in OpenAI in the past few weeks. That was the news. Why? So that OpenAI can buy Nvidia chips. It starts to feel eerily familiar to 1999. Doesn't mean it went badly, but as it is something to take note of. By the close, the indices were still hovering near all-time highs, but sentiment was wobbling. Investors wanted to believe, but they also knew the air was getting thin. The Dow was down 0.5%, S&P down 0.25%, and the Nasdaq was flat on the day. Then came Friday, and with it, the reminder that markets can't rally on optimism forever. The sell-off started overseas. Japan's new prime minister made unexpected comments about tightening fiscal policy, which rattled currency markets and sparked a mini risk-off tone. But what really broke the dam was a headline about U.S. slapping 100% tariffs on Chinese goods. Instantly, big tech, especially the semiconductor names that had led all year, turned red. The SOX index, representing the semis, fell more than 6%, its worst day since April. Oil dropped back below $61 a barrel, and gold shot higher again. Fed head Barr tried to offer some calming, saying saying AI-driven productivity could offset some of the growth risk, but the market wasn't buying it. By the close, stocks were sharply lower across the board. Friday's session alone wiped out nearly all of October's gains and marked the first serious test of investor conviction since early summer. As we've discussed, days like this happen in October historically. The Dow was down almost 2%, S&P 500 down 2.75%, and the Nasdaq was down 3.5%. For the week, how did it all shake out? The Dow was down 2.5% for the week. The S&P 500 was down almost 2.5% for the week, and the Nasdaq was down 2.75% for the week. That's the worst weekly performance for the S&P 500 since May. The bigger picture, we're still in a bull market, but one that's increasingly narrow and valuation heavy. AI remains the engine, but when the engine sputters, even slightly, the rest of the market has no backup power. Friday's sell-off doesn't end the story. It just reintroduces volatility. And after 5 straight up weeks, that's probably healthy. As I record this, futures are pointing to a big bounce up. Not sure it will hold, but here is the volatility. Buckle up. Excuse me. Looking ahead, this week officially kicks off earnings season, starting with the big banks. We're going to hear from J.P. Morgan, Wells Fargo, Citigroup, Goldman Sachs, and BlackRock. That's just tomorrow. Bank of America, Morgan Stanley follow on Wednesday. Taiwan Semi and ASML, they sneak into that within the tech space. And Bank of New York Mellon on Thursday, before American Express and Truist wrap things up on Friday. The focus is going to be on credit costs, deposit trends, and capital markets activities. And for the chip makers, how sustainable AI spending really is. On the data side, the government shutdown continues to freeze key reports like CPI, retail sales, and housing starts, which means the Fed is effectively flying without instruments. Chair Powell speaks on Tuesday, and we'll also hear from Waller, Bowman, and Mirren later in the week, all likely trying to reassure investors that policies remain steady. Remember that even without instruments to fly by, I still think you're going to hear them test the waters. We'll see if they keep moving markets. Today, the bond market is closed. While stocks trade normal hours, there may be lighter volume due to a closed bond market and potentially choppy intraday moves. But a closed bond market has not been the recent excuse, so keep buckled up. Here's the takeaway I want to leave you with. Last week's pullback wasn't a surprise. It was overdue. Markets have been sprinting ahead of fundamentals, and when enthusiasm stretches too far, all it takes is one policy shock to remind everyone that risk still exists. But even after a 2.5% weekly drop, the market structure seems to be remaining intact. Earnings growth is still positive, inflation continues to cool, and the Fed hasn't hinted at tightening. So yes, volatility is back, but for disciplined investors, that's not a problem. It may present an opportunity. We'll use this week's bank earnings to gauge credit strength and consumer demand and watch how quickly buyers return after Friday's sell-off. Because as we've seen time and again, markets climb walls of worry far better than they climb walls of certainty. Keep an eye on the early earnings, and as always, stay focused on your plan, not the noise. I'll see you next week.